joining us is both Megan Schwab and Christopher Whitaker. And so we're going to start with Chris. Chris is our lead financial planner here at Apriem Advisors. He's both a certified financial planner and what is known as an accredited investment fiduciary. He attained his bachelor's degree from Point Loma University in San Diego, California, and his advanced credentials from Boston Institute of Finance. Before coming to Apriem, Chris worked at a high net worth planning firm where he was trained in each of the financial planning domains. Chris is married with 2 small children that happily take up all of his free time. Then we have Megan Schwab, who graduated from Biola University in 2018 with a BS in accounting. And she first got her start in the industry as an intern here at Apriem and officially was asked to join the team in January of 2020. She is a financial planner and is also an accredited investment fiduciary. But what I think is even more exciting is she is the newest certified financial planner on the team. Megan, when did you pass your CFP exam?
In November, so just a few months ago. So
that's a big congratulations to Megan. That is a very, very difficult exam to get through. How was it?
It was worth every second. I'm really happy I have it now. It's very difficult, but worth all the work.
that is a huge feat, and so just congratulations to you, Megan. And with that, I'm gonna go ahead and pass it over to our 2 CFPs to take it away.
Thank you, Josh, for that very kind introduction, as always, and welcome everyone. We're really excited to kick off Apriem's 2022 webinars here, and we got a lot of great content coming your way this year. And today is all about setting a good foundation and is geared towards the basics of personal finance. So for those of you who don't already know, Apriem is constantly pushing for ways to sustain multi-generational wealth. Unfortunately, more than 90% of all family wealth is lost by the 3rd generation, and our firm has a passion to be an antidote for that. And apparently, my understanding is we have 6 different generations listening live today, which is really exciting and a testament to that mission. Also, on a more somber note, I just want to recognize that we've had way too many loved ones pass recently due to everything that's going on in the world today. And we know how important empowering people financially was to them, and also all of the necessary planning that goes into preparing for those that have to go through that pain and the loved ones that they leave behind. So this series is also meant to honor our loved ones and their legacies. So I think there's something for everyone today. Whether you're just starting out in wealth building, you're an established investor in the middle of your journey looking to pick up a few tips, or maybe you're a very experienced investor who's just here for some basic batting practice because you can never get enough of the basics and you just love the game, right? I know there's several of you on this call for that reason. So with that being said, let's dig in, and I'm going to intro one of my favorite financial concepts, which is financial freedom. Basically, when we're building financial plans, the easiest way to do that is to work backwards from an end goal. And the reason we're starting here is because I think financial freedom addresses a lot of the why of personal finance and how almost everyone has at least one major financial goal in common, which is to someday stop trading in your most valuable resource, which is time, for money. And instead, you have your money work for you and make you more money, right? And time and money have a very intertwined relationship in capitalistic economies, especially like ours. I think if you were to ask the average person to actually define money, you'd get a lot of different answers. By the way, just as a side note, I encourage you to ask any kids around you what the definition of money is. You're gonna get some interesting answers. But I think the average adult might tell you some kind of definition like it's a medium of exchange type of definition. And while that's certainly not wrong, I think at the heart of personal finance kind of needs to be an understanding that money is an exchange of our most valuable resource, right? So I just want to unpack that for a second. When you're just starting out, you're exchanging your time for money, right? And then you do your best to save some of that money, AKA stored time, and you take that stored time and you go buy something productive, like a stock, for example. And that stock gets its value from earnings derived from thousands of other people's time and effort spending, building these companies' products, et cetera, right? And so once you've stored enough of it, you can stop trading in your own time, right? And the assets you built can create income and value that you can live off of for an indefinite amount of time, right? And that's really financial freedom. And so personal finance then gets broken down into more granular details and financial jargon that we'll be unpacking. But at its core, this concept is key to building an efficient and effective financial foundation. And so building wealth certainly has its nuances and complexities, but I think this topic gets way too complicated, in my opinion. And so at its core, I just wanted to break it down into 3 simple paths to wealth. So path 1, you spend less than you earn. That's path 1. Path 2, you earn more than you spend, right? Some people choose that path. And path 3 is you do a little bit of both. And so the asterisk here is that in all 3 paths, you need to do something productive with the savings and build towards that financial freedom I was describing. Right, so I just want to kind of tell a story here. So my first day as a full planner, I had 2 very different meetings that I'm never going to forget. The first meeting, this person pulls up in a brand new Porsche, expensive Rolex. It sits down for their planning session, and as you can tell by my foreshadowing tone, they were all hat, no cattle, right? They just had a bunch of debt, right? And so they were making $1 million and spending 1.1 million, right? One of those kinds of stories. Now the second meeting, this person pulls up in a used Camry, simple clothing, never made more than 70K in a given year, and yet when they sat down, they were a multi-millionaire, able to comfortably retire, right? And the difference was just a simple shift in one person's ability to follow one of those 3 paths of wealth, and that person chose to spend less than they earned, and in saving that and compounding that into the future, which I think is a perfect segue real quick into the next point you see there, which is the investor definition of assets and liabilities. So a textbook is going to tell you that an asset is something that has value, positive value on a balance sheet. A textbook would tell you liability is its counterpoint, right? It's the other side of the coin, something that has a negative value or a debt on a balance sheet. And that's technically true, but for wealth building purposes and financial freedom purposes, I'd like to change that definition a little bit in your minds. So I want you to now kind of categorize an asset as anything that puts more money in your pocket. That's it. An asset is something that puts more money in your pocket. And then a liability is, again, the opposite of that, right? So vice versa, a liability is anything that takes money from your pocket, right? So just some classic examples, right? Your primary vehicle in this example, textbook says asset because it has resale value. I say that if it's just a primary vehicle, it's actually a liability when it comes to investing, because even if it's paid off, you've got insurance and fuel costs, et cetera, right? Same thing with boats, et cetera. And so if you spend your life with a cash flow surplus by being on one of those 3 paths, and then buy the investor definition of assets with that surplus, you have no choice but to eventually be wealthy if you just keep doing that over and over and over. And that sounds simple, and it is simple, and that's the point, right? And the last one here is when I was a kid learning about finance, I had this light bulb moment where I learned about dividends and how all dividends is basically profit that the company pushes out to people that own the stock. So at the time I was looking at a stock and it paid about a 3% dividend. And I just realized that if I just owned enough of that stock, then I could just live off the dividends, right? And stop trading in my time. And so I'm going to finish this section with just a very basic breakdown of $1 million. So you can see on the screen there, off $1 million, if you had 2% dividends and interest, and then a few percentage points of appreciation, I'm choosing 3 there for a 5% long-term average, right? That's 20K plus 30K equals 50K of income that you didn't have to trade your time in for. So if you just kind of think that way and keep building, that's really the basics of financial freedom. But before we go too deep into any of this stuff, I'm going to pass it back to Megan, who has a very important section to go over with us, which is absolutely crucial. So I'll pass it back to you.
Thanks, Chris. We're going to go ahead and get started with a very simple topic, emergency funds. That money you have set aside for a rainy day expense. It's really important to have these funds set aside. And Chris and I have a lot of young accumulators come to us and ask, where should I hold my emergency fund? How much should I have in my emergency fund? So to start, these funds should be invested in vehicles with 2 things, high accessibility and minimal principal fluctuation. So simply this means having that money very liquid. So most commonly you'd see these funds in a checking or savings account, sometimes even in a money market or even a CD with a low maturity. It's really important to keep funds in those, because if you put it, we'll talk about brokerage accounts later, but if you put it in something like a brokerage account with so much fluctuation, you may not have enough to cover your emergency expense depending on how the market does in a given day. Another important note about emergency funds is time frames. Should I keep 3 months worth of expenses, 1 month worth of expenses? And that really varies depending on your life stage and your situation. If you're a young accumulator and you just don't, have enough saved yet to have a full 6 months worth of expenses, you should be proud that you even have 1 month. You're a lot further along than most people in the US. But again, it depends. How risk tolerant are you? What's your risk capacity? So, you know, how much risk are you willing to take? How much funds should you have on hand? And also what stage of life you're in. If you're earning money and continuing to accumulate more every single month through your work, you know, maybe you could have a smaller emergency fund. But if you're in retirement, it might serve your best interest to have a larger emergency fund. So as you'll hear often through, you know, in your conversations with us and throughout this webinar, it all depends on your financial situation. But yeah, with that, I'm going to go ahead and pass it back to Chris.
Okay, I get to talk about cash flow management. So if there's any Parks and Recs fans, you can see Andy or Chris Pratt's character right there. I think we can all kind of relate with that image, right? I don't know how much money is my bank account because I'm too afraid to check. Everyone's been there at least once in their life. And so I think with cash flow, right, I think this topic is interesting because it's a combination of both psychology and simple math, right? And so the first thing everyone has to do is actually just be aware of where their money is going. And that, I know it sounds really simple, but in practice, I find that very few people actually do this. And so I think it's also something that's a learned habit over time. So I think a lot of people just don't start this habit while they're younger. And then later on, it's more cumbersome, both emotionally and mechanically, to track larger household income and budgets and things like that. But something certainly never too late to start. But most importantly, you need to come up with a system that works for you, right? And you can do trial and error. So personal story, so my wife and I use a very simple system on purpose. We tried some more complicated ones, just never worked for us. And so for us, we have this simple manual entry app and that we share, and that every time either of us spends on something, we enter it on the shared app. So at any point, basically, anytime I want, I can go in there, look at the app, and you can see where we're at with the budget on any given day of the month. And there's tons of great free resources that you could use, right? There's other apps. You could use a shared spreadsheet or just a simple Google Doc, etc. As long as you know where each dollar is actually going each month and force yourself to keep track, this is really a huge life-changing thing just to be aware of. Again, that very few people actually do, but when you do it, it's incredibly powerful. Also, by the way, just kind of a recap right from slide one, that's lets you way more easily see where you're at on choosing which path of wealth you want to go down. And so that's a good segue to the next section here, which is going to be about spending ratios. I get this question a lot, like, Chris, what kind of, is there a ratio? Is there a metric I can use, something like that? So I'm going to go over a couple that I've used personally and had some success with. So the first one is for early stage when you're just starting out, and it's called the 70-20-10 rule. And for me, this helped especially early on to be just disciplined, make it automatic to go after bigger life stage goals, like that first property you try and buy, or a car, or a engagement ring, or whatever it is, right? And so here's the idea. So out of every dollar, you take 70 cents, or 70% of every dollar that you make, and it goes towards living in general, everything, whether it's housing, entertainment, travel, etc. Everyone's a little bit different on how you want to slice and dice that 70 cents or 70%, but that's the idea. The next 20% is going to go for short-term goals. Again, that first property, that next car, whatever it is, right? And then 10% goes towards the long term. And this is, again, much longer term here. You're always building something for your far off future, but the majority of your money is going towards current spending and current savings. And then as you kind of enter the mid stage where maybe you've gotten that first property or maybe you got that first car, et cetera, you can kind of expand it. So I'll give you one small example where you go, instead of 70-20-10, you go 70-10-10-10, right? Same premise. So 70% goes towards everything. And then 10% for the very, very long term, 10% for intermediate range goals, like maybe you want to retire slightly early, or a bigger goal that's 10 years or 15 years off, like if you young kids are for college or things like that. And then you still have 10% going towards short-term savings. And obviously, as you continue to get more, further along in the financial journey, then you can make customized ratios and things. But hopefully that's helpful for some of you that are just starting out. The next topic is a fun one, which is the power of compounding. And as far as compounding goes, as humans, our minds are just terrible at exponential math, right? I like math a lot, but exponential math is difficult to do in our heads. And we're very linear thinkers as humans. And so things like 8 times 8, equals 64 is pretty easy. But 8 to the 8th power, right? 8 times 8 times 8, 8 times, is more than 16 million, right? So huge, huge leaps when you talk about exponential math. So I have one fun example. So if no matter how bad you are at golf, there's got to be someone out there that's worse, right? So here's what you do. You go to a golf course. In the very first hole, you say, hey, let's bet $1 on this hole. Make sure they're worse than you because it's going to get heavy. So You start with $1, and then you say every hole we're going to double it. So $1, $2, $4, right? You get me, Josh, right? But fourth hole will be $8, right?
Yeah.
Sound good?
Yeah.
Okay.
Do it.
So with compounding math, right? By the 16th hole, your friend better have some deep pockets because the number's $32,768 for whoever wins that hole. The next hole is over 65 grand, and that makes the last hole more than 131,000 on the 18th hole, right? So there's compounding for you. And there's a ton of crazy examples. There's some really good ones out there, but really the idea here is that compound interest really is this incredible force that snowballs to what is a seemingly impossibly big number logically, right? And usually around this time, I get the question, well, Chris, why doesn't everyone just get fabulously wealthy with all this amazing compound interest? And the short answer is most people give up. That's just the truth of it. Replace those golf holes with years and years of compounding. And you can see it takes a long time to get to big numbers, and to see those meaningful numbers start to show up in your compounded totals. So I just encourage everyone who, just to stick with the plan and let that magic play out. And it takes decades for that math to play out. A lot of patience. And the big trick here is to make it automatic, right? I cannot stress this enough. The successful plans that I see are people that are following these kinds of things and making it automatic, right? It could be taken automatically from your account into a brokerage or automatically into your retirement account at work, etc. You just set it and forget it and let it work for you 24/7 without you having to think about it. It's the best way to do it. And the last point here for cash flow management is multiple sources as passive as possible. So there's a lot of great passive income books and YouTube videos, etc. out there. But what I want to focus on is, so there's this great book called The Millionaire Next Door. And it's basically just this aggregate of millionaires across America and how they got to where they are. And one of the things I found fascinating was that most people that got to that level of wealth had 5 to 7 streams of income. And most of those were incredibly passive, which took very little time off their plate. Now that might sound like a lot, right? So I know some of you are thinking immediately, wait, 7 jobs, how's that gonna happen, right? But if you think about it for a second, you probably have more streams than you realize. So if you just had your main job and then a diversified portfolio, that's already gonna get you to 4. So you have your main job, you've got dividends, you've got interest, and you've got capital appreciation and capital gains, right? So that's already 4. If you throw in a little bit of rental income, a passive side hustle, a business, etc., you can get to 5 to 7 pretty quick. And so again, the point here is going back to an earlier slide, right? You need to be using your savings to buy more and more assets that put more and more money in your pocket, and again, as passively as possible. And that's cash flow management 101. Back to you, Megan.
Great. All right, now we're going to go ahead and step into debt management. And before we start, growing up, my dad would talk about debt a lot. He would always say, consumer debt is bad, you should never have any. And as a 7-year-old, I didn't even know what consumer meant, but I just knew consumer debt equaled bad. And I think that really personally helped me in how I apply myself with my own finances and then how I do my work here. It was a really simple base that I started with as a child, but it really helped me personally and in my career. But with debt management, there's a lot of stigma about debt and how it can impact us. But it can be broken up into 2 categories. There's good debt and there's bad debt. And I know most people don't see any debt as good, but good debt has the potential to increase your net worth. So a great example of this is a mortgage. Most people can't afford to buy a house without debt. They're just so expensive. So leveraging some of the expense with a mortgage payment is helpful, and it'll get you to own a home one day, which hopefully grows in value. Another example, the student loans, like I mentioned, that has the opportunity to increase your earnings potential. And again, like a house, a lot of people can't afford to pay for school out of pocket. So this is a very good option to use to your advantage. And then of course, bad debt. I think a lot of us know what bad debt entails and how it can impact our lives. But it basically, if you're borrowing to purchase a depreciating asset, that would be a form of bad debt. So credit cards fall into this category because of their really high interest rates, auto loans with a long term. And I do want to emphasize the idea of a long term here, because like the student loans and the mortgages, people may not be able to afford a car outright either. But if you're able to find an auto loan with a low interest rate and maybe a shorter term, that can be good for you as well. And of course, it's also important to note that too much good debt can turn into bad debt. So you do want to be careful with how much of that good debt you are taking on, even though maybe one day it'll pay off for something great and increase your net worth. Too much of it at one time could hurt you in the long run. So we're going to cover a few different topics on this slide. Our goal here is for you not to end up like Michael Scott. We don't want anyone declaring bankruptcy. But these are some good, background information for you to know how your debt works, and then just some myths about interest that we commonly hear here at the office, and I'm sure just around in our daily lives. So the first is an amortization schedule. All debt follows an amortization schedule. It is just an important tool in tracking your loan payments and how much of each payment is going toward interest and how much is going toward principal each month, or however often you have to pay that debt. For me, I think it's just a good visual to know where my money is going and how quickly I'm going to be able to get something paid off. And speaking of interest, there's a lot of myths about interest. The first is that not all interest is paid off at the beginning of a loan term. Some people may say that, and it's actually more of a proportional situation. So the amount of interest you owe is based on the principal balance of your loan. And as the principal balance goes down, so does the amount of interest owed. So while it's true that more interest is paid in the beginning of the term, the interest doesn't simply go away as you get closer to the end of the term. Just less of a single payment is going toward the interest portion. And the second one, which I think blows a lot of people's minds when we tell them this, is it doesn't always make sense to pay off a loan early. Say you have $10,000 that you can use. You can either pay down your loan with a 4% interest rate, or you can invest it in an account that is averaging a 7% return. And you might see where I'm going with this, or you might have heard it from Chris before in a meeting. Mathematically, it'll always make sense to invest the money because the amount you will earn through compound interest is greater than the interest rate on the loan, and therefore it has a higher earning potential. However, mathematics and emotions are two different things. The feeling of paying off debt is invaluable to some, and it may outweigh any potential earnings you can have. So as we like to say, there are some cases, even with good debt, that there isn't a right or wrong on whether or not you should pay it off. But it is important to know that mathematically, it'll probably make sense. And we do want to emphasize that this is for good debt. And then finally, the APR versus APY. I've learned a lot about this throughout the years. I think it's really important to know the difference between the two because it really impacts how much you're paying off for a debt or how much you're getting in return through an investment. APR, or an annual percentage rate, is the annual rate charged for a loan or earned by an investment. So basically, it's just a calculation of simple interest. You've probably seen so many advertisements for different credit cards and all that they can offer you through points and whatnot, and they'll often advertise it through using APR because it makes it seem that the consumer is paying less in the interest. But the calculation of this is just a periodic rate times the number of periods in a year. So it doesn't take into account at all how many times that rate is being applied to the balance in any given year. So that takes us to the annual percentage yield, and this is the real rate of return. So it's considering compound interest, and it takes into account the frequency at which the rate is being applied. This is also known as intra-year compounding. So the more frequently the interest compounds, the greater the difference between the annual percentage rate and the annual percentage yield. So I do have an example about this to kind of highlight how it works in an investment scenario. So say you invest $10,000 in a high yield savings account with an annual interest rate of 5%. If you know anything about the interest rate environment right now, you know it's near impossible to find a savings account with 5% interest. But for the sake of even math, we're going to use it. If you consider only the annual percentage rate, you'd expect to earn $500 per year in interest. For example, a total of $1,500 earned in interest over a 3-year period. But if we apply annual percentage yield to that calculation, assuming the same 5% interest rate, in the first year, the yield will be the same 5% of $10,000, so $500 at the end of year 1. But in year 2, the interest rate will now be applied to $10,500. So in that case, you'd earn $525 in interest, and so on and so forth. So you could see how, Chris talked about compounding interest earlier. Over the years, the more you make through interest, the bigger your balance becomes and the greater interest earned over time. So that's a really important thing to note as you look at different financing options and also as you try to calculate how much you can earn on an investment.
I needed you, Megan, when I did my first car purchase, when they did the APR as the teaser, but what I was really paying was the higher interest. So, no.
Yeah, the one I always keep in mind is we think about 10% simple interest, right? That doubles in 10 years, right? So $100,000 at 10% of 10,000, right? I get 10,000 10 times. I now have $200,000. But it only takes 7.2% interest compounded to double over that same 10-year period of time. Right? So it shows the power of the compounding. It's only 7.2% compounded for doubling, where it would take at least 10% of simple interest in order to make the same amount of money.
Yeah.
Totally.
The rule of 72 for anyone listening.
There you go.
All right.
All right. Up to you, Chris.
Okay, so I put this in here because I get asked this a lot, and I want to do one huge, take massive step back for a second before we go into this. I can promise you, as someone who works with money 24/7, all on the clock, and deals with very different levels of wealth across the board, just getting to a higher level of wealth is not going to make you happy. So I just want to put that out there first, okay? Now, with that being said, I know a lot of you listening are very goal-oriented, and I do get this question a lot. So again, I'm pulling this from the Millionaire Next Door book series, and this is a little bit of an adaptation of that. But it's a very interesting way if you really want to know kind of some different wealth building goals, what you can do. So it's a very simple formula. You take your age times your pre-tax income divided by 10. Now, again, I want to put a precursor on this. When you first do this, I guarantee you, you're gonna fall pretty far below the average when you first start. It's a very it's a harsh formula. It's meant to kind of empower you to go after big goals, right? And this is, again, coming from a millionaire book, right? So with that being said, I put an asterisk here. It's important for anyone who's looking at this. What you should do to normalize it is compound your savings into the future to see where you're headed, right? So you can take a glance at where you are now, then take those previous slides we've been talking about, figure out what you can save, and then compound that, and then redo the calculation with your projected wealth, and I bet you're going to end up a lot higher on this scale. So with that being said, you can kind of see here the simple example. So this is an age 30, gross income of 50K, 30 times 50 divided by 10 is 150, would be the baseline net worth. And so most people are going to fall 1/2 or less of the baseline, right? So 75K or less is a vast majority of people's net worth at that age and that income level. If you want to be above average, then you're trying to get closer to the baseline of whatever your math works out to. And if you want to be off the charts, there are very few people in the studies that were able to achieve this, but if you want to be off the charts, then you would 2 times that baseline. That would be an interesting goal to kind of shoot for on the very long term. If anyone has any individual questions about this or ways to critique this or tweak this, let me know and we can talk about it one-on-one. Go back to you, Megan.
So now we're going to go ahead and get into the different types of accounts you can use to grow your wealth and maybe achieve the off-the-chart status that Chris was talking about. There are several different types of accounts to choose from, and they all serve a unique purpose, but they can efficiently work together to help build your wealth or achieve whatever goal it is you're trying to achieve. The accounts I'm going to go through today are just a few of all the options that are out there. We just felt that these would be the most applicable for today's purposes, but if you have more questions about how these would work for you personally, we highly encourage you to reach out to your wealth manager to talk more about it in your personal situation. First is a brokerage account. We like to call this a fancy savings. Monies in this account can be invested in things like stocks, bonds, ETFs, mutual funds. And the nice thing about these types of accounts is that you can take the money out at any time without any penalty. You'll just be taxed on any gains that you make. The next one, a UTMA or a UGMA. So these work very similarly to a brokerage account, except they are a custodial brokerage account. So if you have a child and you want to start investing on their behalf for them and get them a head start when they reach adulthood, this is an option you could use. So again, you can invest in stocks, bonds, ETFs, all the same options as a brokerage account. The only caveat here is that the child must take ownership of the account between ages 18 and 25. That age of majority depends on what state you're in. So that's one of the biggest caveats with that account. But it is a really good option if you want to give your kid a head start, or if that's your way of helping them buy a house one day, or whatever your goal is for them. The next one there is a 529 plan, and this is an educational savings account. So this is tax-free savings for qualified educational expenses. And you have the opportunity to use your $16,000 annual gift exclusion by putting money in this account. And there is a strategy called super funding. Say I have a child and I want to put as much as I can into the 529 plan while they're young, so that there's more time for that compound interest to take effect until they go to college. I can put $80,000 into that account this year, which is 5 years worth of the annual exclusion. This allows the annual gift tax exclusion to be applied over a 5-year period. So I'm able to put more into my child's account, use that gift tax exclusion, and now there's $80,000 that has a longer period of time to grow before it has to be used. So there are two other caveats with this type of plan. The first is that if the distributions you take from the plan aren't for qualified educational expenses, then you're subject to a 10% penalty. But on the bright side, the beneficiary can change on the account. So say that my child went to college, they used the 529 plan, but that account still had $50,000 in it when they graduated, and they weren't planning on going to school anymore. Well, if I had a niece or nephew that was younger and I wanted to help with their education, I could simply change the beneficiary on that 529 plan and use those funds towards their education. So I like to think of it as a gift that keeps on giving in more ways than one. And now we're going to go ahead and talk about a few different types of retirement accounts. Like the other accounts, each one offers a different type of strategy, serve a different purpose, but they all work together to fund your retirement. They can maximize your tax savings, and in certain circumstances, they can play a really pivotal role in things like charitable and estate planning. So the first one I'm going to talk about is a Roth IRA. In Roth IRAs, a contribution is made with post-tax dollars. So this means that I'll receive my paycheck. It'll have been taxed, so I have my take-home pay, and I can use a portion of that and put it into my Roth IRA. From then on, the investment gains can grow tax-free. There are some opportunities to take withdrawals before age 59 and a half. If you want to buy your first house, you can use up to $10,000 of your Roth IRA towards the purchase of your first home without incurring any type of 10% penalty. There are also different strategies you can use to fund your Roth IRA. There are income limitations. So say you've reached that $204,000 income limitation if you're married filing jointly. You can use something called a backdoor Roth strategy to get money ultimately into that account. One last positive about the Roth IRA is that there's no RMDs when you reach age 72 and a half. So many people like to hear that and like that feature. Next is a traditional IRA. So this is tax deferred growth. Money in this account is typically funded with pre-tax dollars. There are no income limitations to open and or contribute to an account. And then current year contributions can be tax deductible if you meet certain income limitations, or if you're not an active participant in your employer's retirement plan. And then this next point I want to make is about IRAs as a whole. So whether you have a Roth IRA, traditional IRA, or both, the IRA contribution limitation is $6,000 a year. And IRAs use an aggregation rule. So if I contributed $4,000 to my Roth IRA this year, and I wanted to contribute to my traditional IRA as well, I could only contribute $2,000 into that traditional IRA to get me to the total of $6,000. And finally, our last section here on retirement accounts is 401k plans, which are one of the most common, and there's so many others that you have options for as well. But for a 401k, the maximum contribution for this year is $20,500. And if you're over 50, there's a $6,500 catch-up contribution annually. And then there's also opportunities in a 401k for your employer to match your contribution or even participate in a profit sharing program. And as I just mentioned, there's so many other options available, specifically to if you're self-employed or have few employees. I would encourage you again to talk to your wealth manager about, your situation and if there is another plan that would work well for you. Back to Chris.
Okay, I get to do some tax myths here. So I get a lot of different comments and questions around this topic, and so I wanted to just kind of end with some helpful tax tips and some things that I wish I knew right off the bat. So the first one we're going to talk about is deductions, and so a tax deduction just lowers your tax liability, right? So it actually just reduces your taxable income. I'm going to go into an example at the bottom there. I'll say that for a second, but it does not reduce it dollar for dollar. All it does is reduce the income off the top that gets run through that calculation, right? I'm bringing this up because I think everyone, maybe has fallen in this trap, or you've heard people say it around you. Oh, I'm gonna do that $50 thing or that $100 dinner or whatever it is because it's a tax deduction. That doesn't mean it's free, and that doesn't, it just means you get somewhat of a discount if it actually is. Which brings me to the next point, which is standard deduction versus itemized deduction. Now this one, I was looking at some IRS statistics and it kind of shocked me a little bit too. So right now, under current tax laws, roughly only 1 in 10 people on average actually itemize under current tax laws. And it's partly because the standard deduction is so big right now. So just kind of an average married couple, your standard deduction is going to be about a little more than 25,000 right now. So that means you'd have to have 25,000 in tax deductible expenses, whether that's partly mortgage interest, property taxes, charitable contributions, et cetera. And a lot of people don't do more than 25,000 of that stuff in a given year. And so the point here is that a lot of people are actually taking that standard deduction. And so one maybe helpful strategy is we could take a look at this together, but maybe lumping some of your deductions together in 1 year and doing them all that year, so it actually is a deduction, right? And so just to kind of hammer this point home, the last little visual here you see is tax deductions versus tax credits. Now, just based on conversations I have with most people around me, I think tax credits are what most people think of as tax deductions. So a tax credit actually reduces your tax liability dollar for dollar. So if you look at that simple equation there, you can see on the screen, both sides 50,000 in taxable revenue, right? On the left-hand side, you have deduction. So that person had 10,000 of deductions that came in, which means they had 40,000 that gets run through the tax tables that Megan's going to go over in a second. And so they're at a 20% tax rate, just to keep it really simple, even math here, they would still owe 8 grand, right? Whereas on the right side, a tax credit, same scenario, 20% tax rate off of 50 grand would be 10K. And then that person had a $10,000 credit, they actually owe $0. So it actually wiped out their tax liability. And so there's a lot of different nuances, and we could talk about this one topic for hours, but I just want to throw it out there because it's something that, as far as taxes go, I think is important for the average everyday person to actually understand when they're going about their financial lives. And then Megan's going to walk us through some bracket basics and plus some more myths.
Yes, I am. As Chris alluded to, navigating your taxes can be so tricky and difficult to understand at first. But once you have an understanding on some of these basics, it can make a really great impact on how you understand and even make financial decisions. I'll never forget, I've shared this story before, when my little sister came home from her first job. She was so excited. She got her first paycheck and she couldn't wait to spend it. And she opened the letter and saw the check and couldn't believe how much money was taken out from taxes. And we spent an hour talking about how it wasn't fair and she just didn't understand. I'm sure I felt that way too when I got my first paycheck during my first job, but it is a funny realization. But once you understand how it works, I think it provides some more insight on how it applies to you. So the first thing I'm going to talk about is the 3 different types of tax systems that we interact with, I would say on a daily basis. So there's regressive, proportional, and progressive. A regressive tax system is when the government assesses the tax as a percentage of the value of the asset that an individual purchases or owns. Think about things like property tax, sales tax, and excise tax. Those all follow this system. The regressive tax system doesn't have regard for the amount of income a person makes. Therefore, it's thought about that low income earners may pay more than high income earners using this system because it is a bigger percentage of the lower earner's income. The next is a proportional tax system, which is also known as a flat tax. The tax rate remains the same regardless of your income or wealth. And it's meant to create a type of equality between the marginal tax rate and the average taxes paid. So an example of this is an occupancy tax that's levied on hotel room charges. So I didn't know this, but in California, there's, I believe, a 14% occupancy tax kind of built into that rate, that per night rate you pay for at a hotel, which I thought was really interesting. And finally, the progressive tax system. So taxes are assessed under this system, and it's based on the amount of taxable income an individual earns. So high earners would pay a higher percentage of tax than a low earner. The tax percentage rate increases at intervals as income increases, and each dollar the individual earns, it would place them in a higher bracket. So I'm going to go over to this next slide to visualize it for you. So what we have on the screen is the 2022 federal tax rate table. I'm going to be talking about specifically the married filing jointly brackets so that you can follow along. You'll see here that the top of the 10% federal income tax bracket for married filing jointly is $20,550. So say my household income is $21,000 for the year. You'll see that some of that jumps into the 12% bracket. But the only amount that would get taxed at the higher 12% rate is the $450. The remaining $20,550 would be taxed at the 10% bracket. So I think that's a really important concept to understand because we've heard a lot of people say, you know, I don't want to jump into the higher tax bracket because I don't want all of my income to be taxed at 32% or whatever the amount is. And while that it is important to keep in mind for tax planning, we thought it would be good to point out just how the system works, especially for our younger accumulators. We thought it would be a really helpful topic.
So just to be clear here, so I'm a single person and I make $89,076. You're telling me, Megan, that only my $1 would be at 24%?
Yes, believe it or not.
Amazing.
But that means your marginal tax bracket is 24%.
That's right. Yes.
But your effective tax rate, which is basically the average rate all the way down to the 10%.
Right.
So if you hear a difference between effective versus marginal, marginal is the highest rate you're taxed at on that $1, where the effective rate would be the average you're paying overall. So maybe you're only like 18% effective, you know, something along those lines.
Perfect.
Definitely. Thanks, Josh. So just going into tax brackets, talking a little bit more about that, the federal tax system follows the progressive system. And as you saw, there's 7 different brackets that you could fall into. Something interesting about the state income tax is that it varies on what system they use. So a majority of states follow the progressive system, similar to federal taxes. There are a few that follow the proportional or flat tax system. And then if you're one of the lucky few in one of these states, some don't impose state income taxes at all, which is a really nice perk.
Would that be considered proportional?
Yes. I don't know, actually.
0% flat tax?
You could call it that. And then finally, just going into capital gains. Capital gains are simply the profit from the sale of an asset. So if you sell a stock for higher than you purchased it, or if you sold a home for higher than you purchased it, it would generate what we call a capital gain. Long-term capital gains, so these are assets sold that are held for longer than 1 year, follow their own progressive system, 0%, 15%, or 20%. Again, all dependent upon what your income is. And then there are short-term capital gains. So these are assets that are held for less than a year and sold at a gain. These are actually taxed at your ordinary income tax rate. So just follow those same federal tax brackets. So for example, if you are in the 24% marginal bracket and sell a stock at a short-term capital gain, those gains would be taxed throughout the same brackets as your ordinary income. So yeah, that was the tax basics and what we had provided today for the webinar, and we really hope you learned a little bit from it. And if you have any questions, we encourage you to reach out.
And before we get to the Q&A, I am excited to introduce a new service that Apriem is going to be offering in the near future. And so I'm going to say it again, I said it before, but you know, again, over 90% of family wealth is lost by the 3rd generation. And Apriem, one of Apriem's key missions is to be an antidote to that problem. And the foundational asset management, or as we affectionately call it, is FAM, is going to be a helpful key to solve that problem. Right? And so I'm just going to go very, very high level for now. We can have one-on-one conversations, but on a high level, this is a program that's meant for people who might not be at a place where they need the full advanced planning, and they just want something that's an easy platform to use. It's lower cost. It has some of those automation aspects that we talked about in previous slides to help you build wealth. And you're still going to have some access to a helpful certified financial planner here at the firm for some basic planning needs. And I feel like this is going to be a great kind of bridge between to help those multi-generations or someone just looking to start out or looking for something simpler. And so again, if you're at all interested in this program for yourself or a loved one who you think might benefit from it, please let us know and we can have a direct one-on-one conversation. So. All right.
Thank you, Chris. Very, very exciting. Okay, so now what we're going to do is we are going to flip everything over for Q&A. So Chris and Megan, if you guys would like to turn your cameras on before we get started. Our first question that we have coming in through here, this is kind of fun. Okay, so the Dave Ramsey method of paying off debt, which is called the snowball method, versus other types of methods. So I love this because, I mean, when I first kind of got introduced to budgeting and everything, I went through Dave Ramsey's Financial Peace University. So Chris, Megan, I don't know who wants to take that, but you want to talk about the differences between that?
Let me jump on it first?
You can go for it.
Okay, all right. So I think to be fair for a second, because I think Dave Ramsey's helped a lot of people. Dave Ramsey you have to think about his audience. He's speaking and preaching to the masses, right? And so what he's going for is a powerful from an emotional perspective. And this is a point that Megan made earlier in the presentation, where sometimes the emotions are more powerful than the math. And so the snowball method, I think, works great, especially for someone struggling to get out of debt. Now, with that being said, we'd be remiss if we didn't mention that there is a more mathematically efficient way to pay off debt, which I think maybe this is what the question's getting at, which is, technically speaking, it doesn't matter the size of the debt. It could be a $500 debt over here, and then you have a $70,000 debt over here, whatever it is, right? Mathematically speaking, what you want to do is you pay off the highest interest rate debt first, regardless of size. And you keep going highest interest rate to lowest interest rate in reverse order, right? Like the highest interest rate, if you have a credit card at 20%, right? Then you have one at 18. I don't care the size. I want you to pay the 20% off first, right? Now, again, Dave Ramsey's coming from that emotional side, right? You get emotional wins. I totally get it, right? I knocked out that $200 debt. Now I have a $1,000 debt, right? You just keep building and building and building. And by the way, just as a quick side note, that's a lot of Dave Ramsey's methodology is more on the emotional and behavioral side of finance. And that's powerful and it works. So
Yeah, just for clarification, so everyone's aware, Dave Ramsey's method, the snowball method, says list out all of your debts, smallest debt on top, largest debt on the bottom, and pay minimums on everything all the way up to the smallest debt, and then do everything you can with all of your extra money to pound out that smallest debt. Once that's gone, you move to the next one, and you take that extra payment that you were making in that small debt, and you roll it to the next one down, and you continue to do this all the way down the list. Don't save the money once that debt's gone. Just continue to push it on to the next debt on the list. And so that's why he calls it the debt snowball. And it's about those emotional wins of checking things off of your list. Chris is right, though, in that total amount of debt at the bottom, if you sum total everything up at the bottom, it's the same pool. It's the same amount of money, right? And so really, mathematically speaking, you will be more successful at an even faster rate if you were to just pay off the highest interest rate debts first, because they can't accumulate as quickly. So I hope that's helpful clarification. Okay, you guys want to move on to the next question?
Sure.
All right, next question on the list is, how do you recommend improving your credit score?
That's a good one.
I'll go ahead and start.
Go for it,
Some of the biggest things, and this is something I had to learn as I've started out on my own, is one, the length of your credit history. So just establishing credit, getting a credit card, and if you don't use it for anything else, just buy a stick of gum or put an automatic subscription payment on it, and make sure you pay it off every single month to establish that you're faithful to pay your credit back, and then you're already building that history of long-standing credit. Another one I can think of right off the bat is don't close any old credit accounts. That's something that does not look good So again, you can follow the same method. Just buy something small with it to keep it active, and of course ensure that you're paying it off as you go.
Yeah, and that's great. The only thing I would want to add is the utilization ratio of building credit. So long story short, what you want to do here is make sure there's never a statement balance that closes and reports that is above 30% of your overall max, right? So just super easy math. Let's say you add up all your credit cards and you got, $10,000 limit or whatever it is, right? And you just want to make sure your statement balance doesn't ever close above 3,000 to stay under the perfect utilization ratio, right? Now, just to be clear, you could charge more than the 3,000. I mean, you could charge 6,000, whatever it is during the month. The key here is to have it paid down to below 30% utilization once the statement actually generates. So if you do all those things, what Megan said, you'd be golden over time.
That's great. And I think that leads us really well into the next question, right? So if somebody has credit card debt, should they be saving for retirement, or should they be taking those dollars to pay off their credit card debt?
That's good.
Go ahead.
Okay, so I would say that I'm going to assume, because most credit cards have a high interest rate, we're talking teens to 20s. I think what you want to do is reliably, you want to pay off the credit card first because the interest rate is so high. Again, kind of going back into a little bit of the presentation before where Megan was talking about interest rates and the math of that, right? To where when you're paying down a debt, it's a little bit like you're almost like reverse investing, getting that kind of return on the dollar, right? So you don't want to invest to try and hope you get more than the 25% interest rate on your credit card, would be kind of the short answer.
Okay, continuing on the debt questions here. Is it okay to use debt to get through a tough situation?
It's not, the ideal thing to use for an emergency, but if that's the resource that you have, it's one of those situations where you've got to do what you got to do. But definitely a good example of why it's good to have an emergency fund and consistently working to build that up.
Yeah, I think the key there, step one, right? Emergency fund. This is where the emergency fund really comes into place and pays off. A side note to something that came up, and I was thinking when we were going through that whole emergency fund presentation, is that one of the things that can help you determine how much of an emergency fund you should have is how is your income paid? Are you on a consistent, do I have a salary where it's the same thing every pay period? In which case, it's pretty obvious what my monthly expenses are and what I need, right? And so they would say, okay, you could do, let's say, 3 months worth of expenses for somebody that has a very regular income, like a salary. Whereas somebody else, if a lot of your income is commission based and it's very variable, right? I sell real estate, and so some months I'm really, really good, and other months it's really, really low. You would want a larger emergency fund, maybe closer to the 6 months, or if you needed to go outside of that, you could go outside of that depending on your situation. So it's a great way, sometimes you have combined in between. My wife has a salary and I'm on commission, or vice versa, and mine's more variable, right? And then we find a medium somewhere in between. Maybe that's where, you're talking the 4 or 5 month range. So it can be helpful there. So I'm gonna jump over. I have one here, but I'm gonna jump past one because I think there's another good debt question that kind of came in, just as we're talking through that, right? So one of the things we had said in the previous slide was that you could actually, too much debt in the long run can hurt you, even if it was what you would consider to be good debt, right? Mm-hmm. And so the question is, how can too much debt hurt you in the long run in trying to create passive income?
You want to take it, or you may take it?
I can start.
Yeah, sure.
Yeah, that's a really good question. I would say to start is, if you have too much debt, and every month you have all of these payments coming in, you'll quickly find, each payment, more and more of it is going to whatever debt it is, even though it's meant to be building up your net worth at some form in the future. But if we even go back to Chris's 70-20-10 rule, I think that's a really good one to follow here and think about when you're trying to figure out how much debt you should have, or good debt you should use towards building your wealth. I think it can get easy to see, the future and all the potential, having all of those mortgages or huge student loans could have, how much more money you could earn in the future. But if you're not careful, not paying attention to how much you're incurring at the moment, it could become a bit detrimental.
Yeah. Yeah, just to, I mean, this is kind of an obvious example that just happened, but because it was kind of still fresh in people's minds, 08, 09, you had people that were incredibly well capitalized on the surface, right? And then what happened was when you have too much, even if it's good debt, you fall into these traps, these liquidity traps, where if this source of income dries up and oh wait a second, I need more money, then you start this negative snowball of having to sell things to pay for your debts, right? Because maybe income sources dry up or what have you, right? There's vacancies, et cetera. And you just get into this negative spiral to where you're having to liquidate. And then as other people are also spiraling around you, all asset prices start to drop. And you get into this really negative circular effect. And that's where I think the most classic example of even if it's good debt can hurt you.
Yeah, it's managing risk. I mean, obvious example, 2008, financial crisis. At that time, probably a lot of people remember there were a lot of foreclosures that were happening. There were a lot of people that couldn't make their mortgage payments. There were a lot of people that couldn't pay their rent. And I knew a lot of folks that had amassed a lot of wonderful passive income and had a lot of rental property where they had just kept rolling and rolling and rolling and rolling, and they built up this massive amounts of debts that ended up losing everything during 2008. Now those are extraneous circumstances, but they occur. It happens. So it's about managing, manage your debt and managing your risk. That you take into account those extraneous circumstances and what happens if and when something like that comes along, because it can and it does. So this last question that I saw come through says, what is the ideal amount for an emergency fund at 59 and a half years old or 65 years old, etc.? And then we have a little extra here that says, with 3 adult kids that need help. This kind of thing actually comes up much more frequently than I think a lot of folks know. But Chris, Megan, you guys want to take a stab at maybe some opinions there?
Yeah, so I'll take it from a purely financial planning kind of type of approach. I think the part of the caveat of your question was the assumption that the person's 59 and a half or older. And so I think there's some serious nuance here where I'm assuming that person has some retirement account savings, brokerage account, et cetera. And to answer that kind of situation, you actually technically need surprisingly less emergency cash per se in terms of traditional emergency funds, because in financial planning, I'm going to count some of that. I'm assuming a diversified portfolio that probably has some allocation towards bonds, different durations of bonds, et cetera, to where you can use some of that as an emergency fund proxy, essentially. So you have your nest egg to fall back on. And so I think in that situation, you actually don't really need too big of an emergency fund, is the short way to answer. Yeah, you guys want to?
Well, I mean, I think that's about dead on. I think by the time you start to get to that age where you're at retirement, you should have a pretty good handle, especially if you've done some retirement planning, you should have a pretty good handle on what are your living expenses, right? And what's the amount of income that I have coming in between both guaranteed sources of income, things like Social Security or pensions, right? And then those non-guaranteed things like withdrawals coming off of my portfolio, dividend income. But I should have a pretty good understanding of what's my income going to look like, and it makes it easier to dial down on what it should be. Now, the part about kids that need help, that's a little bit more flexible. I don't know that there's a straight answer on that piece, aside from, every now and then it's important to have a come to Jesus moment with our adult children.
I want to wait one more back on this question for just a second. I think it's important to, if you're looking, so when I'm doing financial planning, you're going to have typically multiple years at least some kind of more conservative asset. And the reason why I'm saying that is because if you look like statistically, the longest recessions and things do last. It can last up to a couple of years, right? Sure. There's a great book by Tony Robbins, I think, called Unshakable, that goes into a lot of the details and math around long-term recessions and things, and bear markets and crashes. So yeah, I just wanted to add that caveat.
That's great. Okay, so there were some extra questions that came through. Unfortunately, we're right at 10 minutes past of the hour. So for the sake of time, we're going to go ahead and finish things up now. Thank you again for joining us.
Everybody, thank you.
Thank you.